All right. So prior coaching session, I talked about what days are your worst days. Today, I want to talk about just three trades, pretty much, three types of trades that one would take. All right. Let's go to a chalkboard here. Three types of trades one would take. I'm not oversimplifying it because this is just pretty much it. There's going to be a breakout trade, which everybody would understand as the market going up or down and breaking out of what? A range, an identifiable range, and it breaks out through the top side and has follow through up, or breaks out through the downside and has follow through down. It breaks out. It was stuck. You could call it building value. It could be a bell curve, whatever. It breaks out. And breakouts should be momentum. They should be also considered momentum trades. If you're trying to time a breakout, it's imperative that price starts going the way you think it's going to go ASAP, because it's momentum and you need to have momentum in order for momentum trades to work. So you should get it pretty quickly. So a breakout trade is one trade type. The second one is a fade, right? You're fading it. The market's weak and you're looking for a bottom for a bounce. Doesn't have to be a huge bounce, but some kind of bounce that you could, get paid on. And hey, if you get a total reversal of the session, great. But you're fading the market's direction. It's weak and you're looking to get long. Same thing. If it's strong, you're looking to get short, you're fading it, looking for the market to turn back and go lower. Could turn back and go lower a little, a lot, and be a total reversal. But either way, it's a fade. So a breakout trade or a fade. Fade could also be called counter trend, which leads me to the third trade, trend. If you think that strength or weakness is going to stay intact for most of the rest of the session, then you want to get on the team to that side of the market. If you think it's a downtrend, you want to get on the side. What kind of move is that? Let's try that again. If you think the market is trending lower, you want to play it from the short side. If you think it's trending higher, you want to play it from the long side. You could play a breakout trade to the upside. You could buy a pullback, buy it through the highs, sell it through the lows. But what you're doing is you've identified a trend that you think is going to stay and remain, and you're going to play it from that side. I guess, this today, Tuesday, if you're watching this in the future, Tuesday, July 6th, you go back and look at a chart from the open, and a pretty good move lower. And what you want to think about is, are they going to respect these moves with retracements and then qualify it for the continuation? This is the move. This is the retracement. This is the continuation. Again, this is the move. This is the retracement. And this would be the continuation. That's what it looks like illustrated in a book, nice and simple, but it never looks that simple, that plain in real time. And that's what you got to get out of your head. But again, if you're playing the market thinking that the trend is down, playing a pullback is essentially a small fade. And what do I mean by that? You're fading this move up. You're on the team, you're on the side of the trend, it's down. But when you get in, you're fading the pullback, you're fading the retracement back into your potential short position, trying to play it for the continuation down. But it's still on the side of the trend. So you either got a breakout trade that you're trying to take, you're fading the market, and you're counter trend, contrarian, whatever other word you want to use, or you're a trend trader, you identify that there's a trend and you're going to play it from that side. Trends don't happen a lot. You don't generally get a market that goes up all day or down all day. If you can get it for a few hours sometimes. But generally, markets rotate trying to find equilibrium within a session. You generally don't get a day like today, Tuesday, July 6th, where we open up, we get weak, we stay weak. You close your eyes and we're 10 points lower. Close your eyes again, you're another 10 points lower. You generally don't get trends like that. But when you do, it leads me to what we talked about in the prior coaching session. What days are your worst days? Because if you're a fader, downtrends kill you, because all you're doing is trying to buy uptrends or downtrends. But in the case of a downtrend, if you're always contrarian and counter trend and there's a downtrend, all you're doing is buying it, getting long. And if you're not good at qualifying and disqualifying locations, if you're not good at getting out of losers and you're on the wrong side of a trend, those are going to be your worst days. So days like today, where we just continue in one direction, generally are a lot of people who don't know what they're doing's worst days, because they can't get out of one trade that was a long. They might have had a little money into it, and then they goes against them, and they don't have a stop. They're not managing their risk. They might add to it. They might have been averaging ever since the open. They might have had a long trade 30 minutes after the open, and they're still in it. And they added to it. And on a day where it just doesn't come up for breath, that's the day that wipes out all the winnings, if they had any, and then some. Generally, and this is why this is a good expansion on last coaching session's topic of when's your worst day. Well, it depends on what kind of style you're trying to implement. If you're a breakout trader and it's a light volume, tight range day, you're going to have your worst day trying to play breakouts over and over again in a market that's not going anywhere. If you're a fader on a trend day and you're not good, you turn a fading strategy into a fighting strategy, those are your worst days. And then if you're just always trying to play continuation, looking for a trend, looking for more strength or more weakness, because you think every day is a trend day, you're just getting chopped up in the rotation. You're probably letting, if your locations are good, you're looking for too much. And it's a bad day, because even if you get winners, you're looking for more and you're not getting them, because the market generally will make a move, but then just kind of rotate. There's opportunities within the moves, but it's just not that picturesque downtrend or uptrend. And if you read too many books and look at too many illustrations that are picture perfect, and then you try to adopt that picture, that visual, into real-time charts, they're not going to connect. So break down your trades, obviously, ready, aim, fire, but also break down, what kind of trade is this? Is it a fade into support? Is it I'm getting on the short side of a downtrend into resistance? It'll help really avoid what in the past were your worst days. Why am I trying to play breakouts on a light volume, tight range day? Or why aren't I trying to play breakouts on a day where the market's flying around? All right. Now, this leads me to the most important part of any talk when there's talk about trading. No matter what your style you're bringing to the day or to your strategy, 1, 2, or 3, you have to qualify the location of the entry. I know I talk about know where you're getting out before you get in, and it's important as far as managing your risk and everything else. But you always got to get in first. You think about where you want to get out before you get in, but you got to get in first. So if you're a breakout, if you're a fader, if you're with the trend, combination of all 3, man, is this not important? This is your step 3 of any kind of trade style you're trying to execute. And it's about consistency and recognition. And I said this in the trading room. And then someone, I think it was Dorian, said, put an acronym on it. PWAP. What's the PWAP? Prediction with a probability. prediction with a probability. So if you're a fader and the price is coming down and you think it's going to bounce, you could be wrong. But if you have probabilities with your prediction, you could be wrong and make money. You could be wrong and get a head start. You could be wrong and scratch it. You could be wrong with a small loser. But you have to get good at not missing what you're looking for. And the puke tool and the OPP, all this stuff that you guys now see in the trading room has helped so many people stack their probabilities faster as they're able to slow it down by understanding less longs, more shorts, all that stuff. But a prediction with a probability is what you're trying to do to qualify an entry or disqualify an entry. You could be playing from the long side all the way down from 43.5, and we just traded 07 and not be killed if your qualifications and your entries were in good locations, because we've had nice pops. In fact, we had a pop that I thought was going to create sideways to higher price action, and I was wrong, but that doesn't mean I've been long the whole time or trying to get long. Once it broke out from 16, that opinion went by the board. I was like, well, now the Bears are back in control. You have to wait till it trades 07. And the point is qualify and disqualify. But what is it you're looking for? Because if you can't describe what you're looking for, how are you going to see it when it appears? And then everybody's saying things are, maybe moving too fast, or, well, everything you don't understand seems to move fast. And the more you understand it, the slower it appears. To slow it down in your head. A game that you're not used to playing is moving too fast. If you don't know the rules of a game, it's moving too fast. If you're not a professional athlete who's playing the game, it might be. Their job is to slow it down because they understand what they're trying to do. And so if anything is moving too fast, you have to work on understanding it to slow it down. And in a conversation I just had yesterday, one of the difficulties people have trying to learn anything, but especially this, is everybody comes generally to a community with baggage. I mean, all their baggage is bad, but most of it probably is. The baggage of what you learned has to either be unlearned or just don't think about it too much when you're trying to focus and see this. Our brains only have so much capacity. So if you're trying to look for longs to puke and shorts to get in at a support level where prior guys might have been stuck, and where's the hourly and what's the delta doing, and you're trying to look for that, and on top of that, you have 4 other things that you learned in the last 10 years that are irrelevant, well, then you have less of a chance of seeing it and then being able to react to it. So most of the stuff you learned, don't be afraid to let it go. It's irrelevant. I took a lot of classes that the CME offered in 1997, 1996, 1998. I let go of it. It was irrelevant information from the guys that were teaching it. Had no bearing on where price was going. Had no bearing on how I was going to make money trading. You have to let go of stuff that isn't helping you so that you put yourself in a position to recognize and identify the stuff that is going to give you a prediction with a probability. And then it's like, wow, understanding becomes a little bit easier because you're not looking for 10 things, 5 things, 4 things, but only 2 or 3 things. But there are things that people hold on to. Why? Because they invested a lot of money and they invested a lot of time. And the guy must have known what he was talking about because he wrote a book. But it's irrelevant to why price moves right now. And you're going to miss the great qualifiers, the great win moments, because you've got too much clutter in your head. You're a problem solver as a trader. You can't solve problems if you got too many things going on in your head. Focus on this problem with these tools. and then go back and work on the recognition of why you missed something, if you missed something, whether it's a trade or something the tool showed you that you didn't see. Get confident that there's some probabilities here. But you got to be able to describe it. What one of the guys I had in one of these coaching sessions now, probably a year or two ago, if you cannot articulate it, it does not exist. And so to expand upon that, don't articulate 10 things that you're looking for to get long or get short. Because then you're going to miss the important stuff that will help you get long and get short. This the market sliding lower. It's been trending. Short side's the right side, but that doesn't mean you'd make money if you played it from the short side if you're bad at picking location. And it doesn't mean you lost money if you're trying to buy it and got long at different spots, because there's been nice rallies and there's been qualification for short-term lows from those bounces. Does that make sense? So PWAP, prediction with a probability. Get rid of the clutter. Everybody's got clutter in your head. Don't deny that. And just because you spent a lot of time and a lot of money and or both in learning something doesn't mean it's helpful, doesn't mean it's relevant. Just focus on OPP and work yourself backwards. Work yourself on getting a better opinion creator, getting yourself better support resistance, fine, but get good at the understanding of too many shorts will go up, too many longs will probably go down. Probabilities. Moving averages. I'm not saying that that's what people are coming here with. Fibonacci, all this other stuff. If that's something that you're using, it's just something else you got to watch for or remember that's going to hurt recognizing what is important. And I really feel that people do that. They come and they make it harder on themselves to learn and understand because they keep baggage that was baggage from their prior experiences. And you gotta chisel. Some people have to chisel. It should just let it go and watch this stuff. Last week we've seen examples of the OPP tool working, and I mean, if you weren't sure whether or not it truly was gauging other people's positions, you've seen examples now last week where we had a long position after the open. He came in green, and then at the same time he was offering, what was it, a 200 lot above. Let me clear some of this stuff out. He came in green on our vertical, and price got above it, but then there was he was a 200 lot offer. Someone in the room seen him come in at the same time, and then I started recording it, and the market comes down with some big sell orders. He goes away at the same. This gets canceled and pulled, and this goes away at the same exact time. So Dave made an accurate connection between an order and position. So these are tracking other people's positions, and at this point, hopefully you understand the value of tracking other people's positions and the sample side and probability that creates, that when there's too many people that just sold it, they're all looking at each other saying, hope it goes down. Yeah, you too? Yeah, I'm short. So you hope it goes down? Well, yeah, I'm short. How about you, Fred? Yeah, I'm short too. So you hope it goes down? Well, yeah, I'm short. Oh, Johnny? Yeah. Jimmy? Yeah. Everybody's short. Yeah. So you hope it goes down? Yeah. And it's not going down. Yeah. Well, I'm going to buy it. Okay. Well, I might buy it too. All right. Well, I'm going to try to buy it. Okay. Next thing you know, they're all trying to buy it. Fred, Johnny, Paul, Peter, they just couldn't get it to go down. They were all buyers. Other people's position is the room getting too crowded and someone saying fire. Everybody's got to run. The markets are moving. People are yelling fire. Now, in a downtrend day, which we're essentially getting today, right? June or July 6th, if you're watching this in the future. What creates a trend is bigger size coming into the market that sells it downtrend, but they're not coming back to buy it 5 minutes or 5 hours even later. There's a reprice to the downside, big selling coming in that isn't selling necessarily to get short and buy it 5 ticks lower or even 5 minutes lower or a few hours. They're selling it. And they just constantly are getting people trapped long, trap long, trap long. The selling isn't going away, and it's not selling that turns into shorts, that turns into buying. It's just selling that's coming in from institution, hedge funds, whatever. And it just keeps coming in, and it's keeping pressure on the market. And it's that imbalance of sellers that keep coming in. They're not turning into buyers because they're not selling it to get short. They might be selling it to get out of a long position. They may be selling it to get into a spread. They might be selling it to reallocate into bonds. Who knows what they're selling it for? But they're not selling it to buy it 5 minutes later. That's what makes a downtrend in any particular day. And you keep getting people buying it, in bad locations, stuck, and then it adds self-fulfilling prophecy to the downside. All right. Moral of the story: what days are your worst days? Break down your trades. It's either you're trying to play breakouts, you're trying to fade it, trying to get on board a trend. How is that going to help you stay away and know what trading style might not fit the kind of day that it is? Adjust accordingly in real time. Understand that the pictures you see in books aren't going to necessarily look like the real time charts that we try to view. So understand that's going to make it create a easy connection. Probability with prediction rather with probability. Understand that. What does that mean? What are you looking at? And get rid of the clutter. And don't tell me you don't have any clutter. We all do. Get rid of it. I don't mean from your personal life. That should go without saying. It's important to stay as focused as possible when you're in front of your workstation. I mean the clutter of what you think is your edge. If you think your edge is really an edge, okay, fine. But boy, you better articulate it out. If not, it's just clutter, it's baggage, and it's making it more difficult to see the real important information. That is indeed an advantage. Don't forget, if you guys are in here, generally people in here, most have access to Discord. So if you do, make sure you're going there and going in there. It seems like on the other side of this holiday, it's been a nice, a lot more activity in it as we're in the second half of this, unofficially, second half of the summer. If you're watching this in the future, again, this is early July, but the day we're talking about is July 6th. And, for everybody in here live, just stay focused on, think about what trade you're taking. Are you with the trend? Are you fading it? You could, what are you using to actually get in your damn trade? So if you think the market's going to do this, all right, are you getting in? Are you going to try to get in here before it looks like this? You're going to try to get in maybe here. Fine. You have an idea what it's supposed to look like. Somewhat close to that. And then understand, what am I looking for inside these boxes that help me pull the trigger to get in and out? And repetitiously go over that again and again and again and again and again and again. And then when you have your charts and your charts look like this, which candlesticks or footprints, and hopefully they're PNFs, and that's not what a chart in a book is going to look like. But what you're going to do is, if you take this chart, here's what I visualize this chart doing, even though it doesn't look like it would in a book. This chart, just follow this yellow line, was chopping sideways, broke out, had a bottom, came in, and went back up. So it's essentially, let me draw it in red, chop sideways, sold off, bottom, retracement, failure, re-rally. In the book, the red line is what you'd see. But in reality, it's all these candles and noise and everything else. So you got to draw that red line essentially to clear up what the market's actually doing. Draw visually or with well, I could illustrate it because of the tools with Zoom, but have your consolidation boxes, your crooked, if it's a failure like that, looks like a crooked W, draw that in your head before maybe it falls or comes to fruition. So stay safe. We'll see everybody in Discord or in the trading room tomorrow. But just remember, what trade are you trying to implement? Is it a day that's conducive to that style? We'll see you guys.